Well, U.S. tariffs on Canada, Mexico, and China have taken effect, with Canadian retaliatory tariffs also kicking in. Speaking with Money Talk's Greg Bunnell yesterday, TD's Deputy Chief Economist Derek Burleton said the impact of those tariffs on Canada's economy depends how long they stay in place. Take a listen.
The longer they remain on, clearly it gets embedded in investment decisions. And, based on some of our modeling work, 6 months or so would be sufficient to lead to sort of a technical recession in Canada. We wouldn't expect anything too severe. You start getting out to more permanent tariff implementation, and it gets messier and certainly more permanent damage. I have to say, though, just based on some of the news flowing in surveys, there was one released by KPMG the other day that suggests a lot of companies are already looking at their investment decisions, particularly those that operate on both sides of the border. We're hearing some announcements. So even in a no tariff implementation scenario, you're looking at downgraded Canadian views, particularly to investment, and even interest rates. Rates could be lower than expected. So I think that there's a feeling that even if tariffs don't go ahead as threatened, just having that uncertainty hang is going to lead to some fairly significant downgrades to the Canadian outlook.
Now, Derek also says those trade tensions may dominate the outlook for the loonie and interest rates in Canada.
I've been actually surprised that the loonie has been as resilient as it has, given this uncertainty. Some of that was a U.S. dollar story, lower U.S. yields of late, but I expect again, even in a no tariff where the threat is punted down the road, I do expect a little bit lower loonie, and under a more severe case where tariffs go ahead, you're going to be dealing with a lot more weakness in the loonie. Same thing on interest rates. Our view has been 3 rate cuts to the end of the year in Canada. We got a couple in the U.S., and under a more severe scenario, then rates could be a whole lot lower, as low as 1.5 by the end of the year, maybe even a touch lower, a loonie in the mid-60s. So you've got such a wide range of possibilities. This really is an unusual time where, again, the crystal ball maybe isn't sending as clear and vivid a signal as one would like.
The stocks are under pressure amid those new U.S. tariffs. But how should investors be thinking about what it means for markets longer term? Joining us now to discuss the trends he's keeping an eye on is Ben Gossack, Managing Director and Portfolio Manager with TD Asset Management. And Ben, thanks for joining us today. Let's start with those trade headwinds. How should investors be viewing the tariff risks to the markets right now?
Well, thanks for having me. Clearly, there's a lot of negative headlines. We've seen a lot of negative stock prices. I try to come with a cheery tie and it's something bright to bring some type of counterbalance. I think we have to watch the one-day extrapolation. So we saw basically tariffs we saw the headlines yesterday that it was going to be firm. There wasn't going to be any backtracking like we saw maybe about a month ago. So coming in today, we sort of knew that was going to take effect. And so you see stock prices fall. So therefore, this must be a bad thing. This is going to foretell certain dire consequences going forward. I think for me, and again, I really do focus on trends. I think trends are really important and they can be persistent. I think this is a market that had anticipated a Trump presidency as maybe as early as 2023, and we saw markets lead up into that election result. We are also in a risk-off environment, as you highlighted a bunch of various stocks. We've seen competition in AI that we had not expected or anticipated, particularly coming from China, and that has sort of reordered many of the winners, and that's been a risk-off environment. Add in some economic uncertainty about tariffs and what that means, then okay, let's take it down even more. But to talk about in terms of trends, you've highlighted a lot of the auto stocks, Anthony. They're down today, so that must mean that tariffs are bad. And it is bad, but it has been a tough environment for auto stocks now going on for 2+ years. So is today down move new information or just a continuation of the trend? The thing that I keep asking myself is, tariffs are the one thing that people told us to worry about versus the thing that usually is the thing that hurts us that we don't know that's coming along our way. And so there may be people that were surprised that tariffs went through. I have a whole bunch of other people that would say, this administration had to put those tariffs through just to show that they were serious about it. And so then we can all debate what we think that will happen to stock prices.
Okay, talk about the risk-off environment and given all the headwinds. Some investors are worried that markets have been getting a bit complacent about the risks out there. What are your thoughts on that?
Yeah, and I think there are really smart people that spend all day either focused on broad markets, on individual stocks, on individual sectors. So I do hear a lot of that complacency talk. So I read something, I looked at the market, it wasn't acting as I thought it was, therefore it must be complacent. I typically take the other side of that. I think there are very smart people, again, dialed in on whether it's corporate financials, secular trends, industrial trends, macroeconomics, all taking their individual views and then putting it on prices. And it may already be adjusting for certain things or looking 6 months ahead, 9 months ahead, 12 months ahead. So yes, people could say they weren't expecting tariffs, therefore the markets were complacent, and that's why the markets fell. I think there's more going on than just to say it's complacent, and I would fall in the camp that I think we've been talking about tariffs for so long. How could it not be in stock prices?
Okay, I want to talk a little bit about trends because we've already seen a series of mini pullbacks or head fakes recently. But you say that there are signs that stocks may continue to move higher. My apologies. Yes, so there are signs that stocks may continue to move higher despite all that noise. Talk to us a little bit about that.
Yeah, so I brought a bunch of charts just to level set. So even I suffer from this. I see a stock down 5% or up 5%. You think, oh my God, this must be a new trend. There was a headline. And this is why, like I say, let's bring it back into context. So let's just start with the big major index that everyone likes to talk about, which is the S&P 500.
You've got the chart up here right now.
What we're looking at here is the index, and we have had an incredible rally since the summer of 2022. We were basically even about a week or 2 weeks ago at new all-time highs. The bottom chart below is showing you the drawdown from the previous peak. So obviously the big drawdown that we had was 2022 when the markets fell almost 30% from their 21 highs. And since then we've had a 10% pullback in August when we had the dollar-yen currency unwind. This was happening around the Olympics, and it started on Monday and it finished on Friday. We've had a series of 5% pullbacks. One was in September, the other was in December, and currently we're in a 6% pullback. So in the context of the negativity that we're seeing, we're just 6% from the highs. Typically they'll say 10% is correction. If someone were on this show 2 weeks ago, 3 weeks ago and said, Anthony, do you know what? The markets could fall 5-6%. Everyone would say, sure. We do know there's a lot of cash on the sidelines that have been waiting for pullbacks. The pullbacks never happen on great news. It's going to happen on some type of consequential news like, what if we end up in a recession? What if this trade war expands? What if? And this is why we always tell people follow the process, and as opposed to sort of adjusting to these headlines. But I would just say in general, if I were to tell you we'd be down 6% from the highs, you'd say that sounds normal. So I don't think what we're doing is abnormal right now.